Hello, everybody, and welcome today to our episode 2 in our GTLP program. We're joined with our fellow panelists here today to discuss our event for this afternoon, which is we are talking about the topic, the the impact battle and the greenwashing dilemma, and what we need to do to obviously try to make better strides for the future. So we're here joined today with our fellow panelists. I'll first make an introduction about myself. My name is Susan Falola, founder and CEO of Jubix Limited. It's a collaborative financial tool which acts as a distributed multi-cloud based omni-channel for goods and services, offering a SaaS AI matching tool for startups, projects, expertise, and finance, using blockchain to validate, store, and permit user data. So we have today Mita, who's joined with us, and she is an ESG and impact investment specialist. Mita, if you'd like to make a brief introduction.
Great. Thank you, Susan, and hi, everyone. And thank you for having me and inviting me to this panel to join the other two esteemed speakers here. So my name is Mita, and I am, as Susan mentioned, I'm head of impact and outreach at Green Art Capital, which is an impact investment fintech based in Singapore. And we look at closing the SDG financing gap by facilitating debt investments from the private sector towards two key impact themes, which are climate action and financial inclusion. So that is sending credit lending to those at the base of the pyramid or MSMEs, enterprises that do not have access to formal financial channels. It's a pleasure to be here. Thank you.
Thank you for that, Mita. And if we could have Robert give a brief introduction about himself and what he does.
Yes, hi everyone, and thank you for having me today. I am an independent consultant that works across the impact investing field or spectrum, working with a variety of clients, be it donors or development finance institutions, to investors and corporates and ventures or small and growing businesses, because of course there's many actors that are kind of creating impact and coming together to scale interesting solutions in emerging markets, which is really where I focus. So yeah, and my background entails a few years working with the U.S. government and a variety of other kind of consulting, and then the past several years more in the kind of accelerator, startup, early VC space side of this growing impact industry. So looking forward to the conversation today.
Thank you so much for that, Robert. That was a marvelous introduction. And Christopher, over to you.
Thank you, Susan. And yeah, thank you for inviting me here today. So I am the COO at a company called AUAG Funds, and we are creating investor-friendly products with a focus on precious metals and green tech elements. So we invest in the companies that are extracting metals. So it's a bit controversial maybe to talk about ESG and these kind of companies. I'm really looking forward to sharing our perspective, but we really want to make an impact where it matters. So these companies, they have huge carbon emissions, but they have huge potential to decrease them to reach the goals of the Paris Agreement, for example. So yeah, my role at the company is to head the sustainability process when it comes to investments, and I'm also working with our growth and marketing and a couple of other areas. But I put a huge focus on our sustainability. So yeah, thanks for inviting me.
Thank you so much for that, Christopher. So we're just going to go into a brief overview on the topic at hand today. So I'm just going to give a brief introduction. So in regards to the UN Sustainable Development Goals, also known as SDGs, highlighting how sustainability is never just about the environment. The 17 goals are integrated, recognizing that action is one area that will affect outcomes in others, and that development must balance environmental, economic, and social sustainability. Although the planet is often framed as the priority as a genuine sustainable world, won't ever be achieved if we neglect the social and economical pillars of sustainability. We need to hold companies to account, expect more of them, and not settle for empty promises or a veneer of being ethical. Relying on child labor is no more sustainable than being reliant on single-use plastics or fossil fuels, just like how we shouldn't accept companies exploiting the environment for the sake of profits. We cannot accept them exploiting children and depriving them of childhood either. So first, we're going to go into our first question for today. And our first question is, how can we measure impact and have an integrated SDG strategy? So I first would like to bring Mita back into the conversation. Mita, how would you how would you answer this question?
Great. Thank you, Susan. And I think it's actually quite important to just set a bit of context with regards to what impact measurement is. So, as we are emerging and looking forward to from the midst of kind of a global unprecedented economic and health crisis, it's taken over the world. I think COVID-19 actually looks to bring unique opportunities for investing and finance to actually create significant, positive social impact. There's a pivotal opportunity for institutions and investors and enterprises who are all increasingly seeking investments aligned, with social objectives, or specifically the UN SDGs, which has provided a framework for alignment of values, to actually bridge this financing gap and contribute to social development, through the financing of investments and businesses. And we're seeing sustainable finance or investing set to increase to about 95% of global assets by 2030, and an expected wealth transfer of the millennial generation of about $68 trillion to this more socially conscious millennial generation over the coming years. So the investment appetite to actually create significant positive change whilst being financially beneficial has never been larger than it actually is right now. But a key question remains is, and potentially a barrier to this market is that surrounds ESG and sustainable finance is, what difference is my investment actually making? What is its contribution to sustainable development? And that's essentially what the framework of the SDGs was created, to measure. It was a call to action, like a global call to action, essentially. And there is just an imperative need for better integration of sustainability and impact data to reflect the outcomes on beneficiaries and meet client expectations. So the practice of impact measurement, which is obviously the measurement of social and environmental outcomes, which are tracked and measured as part of an investment process, as part of a business's operations, is a key enabler to closing this gap and then kind of ensuring capital is actually deployed and reaching target populations, target sectors, target elements of the environment. And there are a lot of standards out there. There's an alphabet soup of standards that have come out that I think is just confusing in the first instance, and is potentially a barrier to a lot of participants who are now trying to get involved in the space. But there's also coming to the fore, a lot of consolidation, a lot of alignment. There are a lot of industry bodies such as the IMP, the Impact Management Project, SASB, Sustainable Accounting Sustainable Board, GIN. A lot of these industries are actually bringing synergies to the measurement framework, and I think that's something that needs to be more consolidated. I think there's still far too many. It's very confusing. No one really knows how to apply which ones and in which situation. But I think that's a good start with regards to how to approach the impact measurement sector.
Thank you so much for that, Mita, explaining more about the quantitative and qualitative factors that companies need to address and have a look at. Let's go over to Christopher. Christopher, what would be your answer to that question?
Thank you. And as a fund and an asset manager as we are responsible, or our core mission is to allocate the capital of our investors. And with that comes a responsibility to allocate it in a good way where you can actually make a difference. So what we do to measure the impact is that we have initiated a collaboration with Sustainalytics, which is one of the leading ESG analytics platforms. And they have something they call an ESG risk rating, where they they go through a number of different aspects, looking at what a company are exposure towards when it comes to risks, and this varies between different sectors. And then they address how good the companies are in addressing and mitigating these risks, basically. And they cover both environmental, social, and governmental factors. So this is how we can see that this risk is decreasing in the companies that we hold, because we have that in our investment process, that we look at this and we make sure that they become better. And we look at where these companies have weaknesses, and we especially look at the best companies. So we have a best-in-class strategy. What are they doing that is good, and why are not the companies with a higher risk doing it? And then we can measure the progress. So that is one part of it. You have to have some kind of metric or number to look at and see like how it is, how you get to it, basically. So it's not just a black box. So that process is really thorough. So they give us a 90-page report, basically, on every company. There is, I think, they have more than 11,000 companies in their database. So that's one part of the analytics. But then we also do, when we have this, we have a running conversation with all companies to talk to them, basically, and see that we also can, that they tell us, and that we can see that they are doing changes. And it's also reflected in their sustainability reports and so on. But that's really how we try to measure it on a like quarterly and basis and so on. We try to keep this process running to make sure that we keep track of our holdings, and if they don't become better, then we won't allocate capital to them. So like Charlie Munger, he famously said, like, show me the incentives and I'll show you the outcome, right? So if you create the incentives for these companies to become better, that is, they want, of course, their stock value to increase. And they do so by if we allocate capital to it, and all other companies that also hopefully will implement ESG as the core part of their investment process. So yeah, that's what we do. We create these incentives for the companies to want to become a part of our funds and the indexes we create. And then we will drive change to promote change in this sector.
Thank you, Christopher, talking from an investment perspective. And over to you, Robert. How would you address this question?
Yeah, so I completely agree with what we've just heard. I guess this is a complex topic, and there's no one way to measure impact, and it's still evolving, like Mita said. So even the largest organizations and institutions are still trying to figure out exactly how to do this and get consensus amongst themselves and their organizations, right? So I think it's important to realize that impact is about risk and opportunity. Because I think what we're seeing and what we've seen over this evolution, if you will, is the kind of ESG or investment in corporate community thinking about it traditionally more from a risk perspective. And then this kind of emerging impact community and social enterprises and the younger generation that are really out to kind of solve issues and think creatively about and reset how we have industries operating, et cetera, where this is more about being opportunistic and solving issues, and these worlds are coming together. So I think whatever kind of organization you are, you kind of have to hold both these things at the same time, and then think about how you are going to measure that based on your current system in place. But I'd say my advice to kind of new entrance to this space, do look at the SDGs as that kind of guiding light, because that's exactly what Mita was saying. It's really bringing the world together around these high-level goals. That is what they are, and there's still a lot of details that need to be filled out underneath them, even though there are a whole set of indicators and ways to measure against that. But if you're looking at it from a small business perspective, the IRIS, this kind of catalog of impact metrics, and IRIS Plus, which are starting to align with the SDGs, is a real way to help you kind of get started on that journey and figure out what makes sense for you to what makes sense for you and your business and or your solution that you're trying to bring to bear and scale. So yeah, I guess I'll leave it there, because it's a hard thing to talk about in high level terms. I think you have to really get down to the specifics to get into the weeds on this topic.
Thank you so much, Robert. I really appreciate that. Christopher, I actually wanted to put a question in there. I know I haven't actually sent you guys this ahead of time, but I wanted to ask, do you believe that, in terms of, specific, investments in, ESG projects, SDG projects, do you believe that they're accessible? And if so, how can you explain that they are? Because there's been a lot of talk around the fact that they're not accessible, and they have some kind of biased decision making around that. So if you could explain how you feel that they are accessible, and if you do actually agree with me in terms of they're not accessible for everybody, as a whole. Could you speak from that perspective?
Was that a question on that investment products are accessible, or?
So the actual finance towards projects that are related to do with ESG or SDG goals.
How easy it is to invest in them, and how available they are today?
No, in terms of like the funds, are they actually accessible for the people that have projects, related to SDGs? How accessible are they? I know that you're an investment firm, so you're going to shout how accessible you guys are. But
so
the approach is the fact that you're not inaccessible.
In general, I can only speak for ourselves, and we try. Of course, we enable everyone, like retail investors, professional investors, and also institutions, to invest in our funds, which we want to promote change within the mining sector and within green tech. That is, and we have as our philosophy, it isn't closed in any way. We want to have like the minimum available threshold for investing. It's 10 euros, so everybody can participate in this. And we want to be on all platforms, and we are based in Sweden, so we are on all platforms in the Nordics as of now. So Sweden, Finland, and Denmark, Norway. But we actually launched a new fund in July, which is available in all Europe. So that is where we are today, and this can be reached by all investors, basically, which have just a regular stock trading account.
Thank you for that, Christopher. Really appreciate that explanation there. So we're going to go into our next question for this afternoon. So the next question is, for investors exploring ESG projects, investments, and for those who are concerned about ESG washing, how can they properly evaluate companies, and what questions should they be asking? First, I'd like to hand that over to Robert. Robert, are you there?
Yep, I am. So yeah, I think it's important if you're investing in a fund or directly into a business or a venture, for you to really, peel back the curtain and to understand what is the framework and the system that they are using to measure impact. And, again, you don't have to be rigorous in what you're looking for, but it's important to keep digging into the details and asking the questions and understanding the level of detail in which your entity is tracking, what they claim to be having impact on. So again, there's many different ways to do that, but it's about understanding and following that logic on how they are talking about at a high level the impact they're having, and really getting down to the details of the metrics that are tracking that progress, and how are they tracking those metrics, because actually getting that data on a recurring basis is actually a pretty hard thing to do, and it takes time and resources. So, really understanding that as an investor and asking those questions and continue to kind of peel back the layers on that onion, right, to get to what are the details of doing that. That will give you that insights and level of comfort that you would be looking for, because again, if you're not getting kind of substantive answers to these questions, then it's kind of a level of greenwashing, and you might want to move on to the next opportunity.
I absolutely agree with you there, Robert, on that. Mita, would you like to address the question?
Yeah, sure. I actually like wholeheartedly agree with many the points that Robert made. And maybe just to add that there are very different the ESG or sustainable finance spectrum, if we just call it that as a bucket, is very vast. It starts from ESG and negative screening all the way to impact investing, which is very intentional with regards to the impact it's trying to create. So I think an investor also in their approach needs to maybe just understand what they're looking for from an investment product, like whether it is just I want to avoid those funds or businesses that are operating in the coal industry or in certain industries that they are potentially not value aligned with, or they're actually seeking to create better equity between in gender inclusion, inclusivity, or in equity with regards to access to finance or farmers or whatever it is. What are they actually seeking to align themselves with? Because that's actually quite fundamentally different in different approaches and in different investment products within this kind of massive sphere that is now just bracketed as sustainable finance. But even when you're looking at it, I think there's some common threads. You should look at the strategy, of the fund or the business, like depending on which approach you are. In regards to, do they have a statement that commits to operating sustainably and contributing positively to the SDGs? Like, is that actually part of their ethos and their process? And have they taken time to understand what is important to their stakeholders? Because it's no longer about shareholder maximization, but stakeholder maximization. Have they actually thought that through? Have they documented that? And are their processes aligned with that? Is their strategy aligned with that? Do they set goals, for example? Like a lot of firms have now set net zero or carbon neutral goals for 2030 or 2050 or whatever it is. And if they do claim that this is one of their goals, you need to assess, well, what do they have in place to actually, progress towards this? Do they have a strategy in place for reducing their or improving their energy efficiency, or for transitioning to renewable energy sources, or how are they actually going to get there? So these are all things you need to, as Robert's point, you have to look into the detail, because a lot of firms, and I think there's some of the stat, there's like 70% of firms, mention the SDGs. About 14% of them mention specific targets. 1% of them actually report quantitatively on them on a regular basis. So that's a huge difference, because as much as you can align yourselves with an SDG, if you're not measuring and tracking what you're claiming is a contribution to impact, then potentially that is a contribution to impact washing. So you do need to look at what they're measuring and what they're reporting, and if it's in alignment with what they claim. So that's something to be cognizant about when you're evaluating managers or businesses.
Thank you so much, Mita. That was a very in-depth explanation, so I really appreciate that. Christopher, do you want to add anything? I know your panel members have kind of covered a lot. Is there anything
Yeah, that was brilliant by both Robert and Mita, and I completely agree. I just want to add one short thing, and it's basically, I think it's a brilliant question, and before asking the companies anything, I think you should ask yourself what do you want to achieve with your ESG investments, because some, as what we have said, some funds or investors, they want to look good, and then they only invest in companies that are trying to be very good and maybe are not doing the difficult things. Like, say you're a telecom, I will not say any company, a telco company, IT company, something like that. They can probably rather easily have a low carbon emissions. But if you really want to make an impact, maybe you should go into transportation or housing, like construction or mining, where you actually have big emissions and you have this more difficult circumstances, that you have operations where you have people in countries far away, and you need to be really thorough on what you're doing, and it requires a very competent management and on all the systems. It's a bit more complex to get a grasp of what these companies are doing when it comes to ESG, because it can be really difficult to just see based on what you find on on the internet. So then you need other data sources basically. So you need to, like, as an investor, decide on which way do you want to go, and nothing is wrong. Both is good, of course. All companies are just becoming better in the area. It's great, but we have chosen to, like, go into mining, of course, and, like, we want to do a good impact in the mining industry and have an impact and make sure that these companies reach the Paris Agreement goals of 2050, and also work towards the SDGs. And if you look at all these mining companies, they have their sustainability reports where they, every time they report on the SDGs on how they are working to achieve them. And then we can also follow that up on the analytics data that we get from Sustainalytics, of course. But what we thoroughly believe that you cannot achieve a green future if you don't pick these metals out of the ground, like silver or copper or nickel. You can't build a autonomous car, a battery, or a solar cell or anything without them, but you can take them up in a sustainable way. And what you see on the TV sometimes when I talk about mining companies, that's not a high-tech mine. If it's like a high-tech mine today, they use fuel cell trucks. They are connected to the grid, so they can have renewable energy sources. They take care of the social responsibility of the villages where they have the mine. And so on. There's a lot of really good initiatives and really good mining companies out there, and these are the ones we want to promote and make sure that everyone follows their lead. Basically, now I talked on for ages and I probably drifted from the question, so I will shut up with there.
It just shows your passion, Christopher. So and our audience can see that you're not just here just greenwashing us. You're actually here from a passion perspective. So I really appreciate that. So we'll go on to our next question for this afternoon. And the next question is, how can we collectively enforce change from a policy and regulatory perspective? So I know Mita touched on this earlier, but if we could have Robert first and then Mita, if you want to chime in after, that would be fantastic.
Well, maybe a surprising answer would be to bring it down to the basics, and I would say get out and vote. Vote the officials that you want to be in power, who are going to be able to set the policies that we want to achieve. Because I think there is a place for protesting and speaking your mind and affecting change, but I think voting is sometimes the most powerful way. So really got to get people out to do that. But maybe bring it up a level to think about what can you do. I mean, really, this, as an investor, and everyone is an investor, that you really need to realize that. So it is about the choices you make on the day-to-day, but also about companies you're investing in. So I think that helps to build momentum. That's going to increase policy change within corporations, and it is a lot of kind of big industry, big corporations that we need to really affect change on to meet the Paris and the goals and SDGs. So I think those are just from kind of the basic steps that you can make as an individual. So I'll leave it there.
Thank you. Mita?
Sure. I think, to be honest, I think governments will start bringing in regulation. They already have, because they can't really afford not to anymore. And like kind of social, environmental, and even economic outcomes are just increasingly, they're interdependent. And we're not solving for climate change and inequality. They have enormous constraints on the economic potential and stability of regions, and we've seen that concurrently now, where you have wildfires taking stance, across America and Europe. You have, inequality has gone up massively in the last 18 months because of COVID, particularly in the region I am in Southeast Asia and in India. So governments can't really afford to not regulate or bring in policy with regards to greater equity between stakeholders anymore. And I think that's actually been shown with regards to, or driven by the vast amount of private capital that's just going towards that sector. I think it could be a lot more effectively and efficiently directed within the sector. I think a lot of it is, like we've mentioned before, like with impact washing, a lot of people, a lot of funds or businesses, are putting ESG or sustainable finance as a brand, to attract a certain amount of capital that's headed towards that sector at the moment. But we've seen the SFDR come in last year. I know it's still in kind of discussion and transition, but that actually took off $3 trillion from sustainable finance asset allocation last year, because it now requires reporting and regulatory requirements with regards to, if you're going to claim ESG or sustainability or impact, you have to now show the accountability with regards to that claim. Asia is now following suit. All especially where I'm in Singapore, all companies now need to do sustainability reporting. All financial institutions as of next year also need to report on their climate impact on an annual basis. So I think policy changes they're following quite swiftly with regards to following actual private capital demand, with regards to accountability, credibility, and also from a reputational point of view, because I think they've realized that this is actually now not a nice to have, but just it's market norm. It's not going anywhere. I think it's here to stay, and there's a huge call for action. So I think, to be honest, I don't think governments, I think they're now following suit with regards to a lot of the regulations they're introducing. So hopefully it will actually get. I think there probably needs to be a little more taxonomy with regards to the regulations, because they're a little bit fragmented. But I think that's, again, just work in progress. And, as Robert said earlier, it's still a very nascent market. It's new, it's developing, and standards and regulations will have to evolve with that continuously.
Thank you so much, Mita. Christopher?
Yeah, I guess there isn't much left to be said on that one. Yeah, but like, just to catch on what Mita said there, like the SFDR regulation that has come, they're really, like, it's a great start. So to look at the fund facts and see how they relate to those regulations. Like if it's an Article 6, 8, or 9 fund, that's a really good start. And we're having these structures, and it's great that somebody's really taking a hold of this and making sure that it's easier for the investor to understand. But from our perspective as a fund, and I was talking a bit about this in the beginning, but our mission is to, like, we have the collective vote of all our investors, and with those votes we can make a change. So that is a way you can, like, with your wallet, enforce change, basically. And then also, like, in your daily life, of course, buy the products from the companies that you think are behaving well and following this, like aiming for these goals. That is also something that everyone can do. So I think it shouldn't be like, it isn't that difficult, and you should also see that there's a possibility to, like, when you invest, it isn't I need to either invest in ESG or get good returns. Maybe I think there is a middle way, and that you can find really interesting opportunities that encapsulate both.
Thank you, Christopher. So we're going to go into our last but not least question for this afternoon, and that is, what are the most compelling sustainability targets and goals, and how close are we to achieving them? So I know it's quite a big question, but obviously we were supposed to achieve them by 2020, and obviously that's not happened. So how far are we away from actually achieving these goals? And actually, can we actually say can we actually say a duration of time that we will be able to implement all of them? Let's start with Mita, if you don't mind.
Sure. So I don't think there's a simple answer to that question at all, but I'll give you my 2 cents. I think so we are further away than we were back in 2015 with regards to getting to the SDGs by 2030. I think when they were announced, it was $2.5 trillion a year annual financing gap. It's now gone up to about 4 or 5 if we want to achieve them by 2030. But that's not because, and sadly, COVID has contributed to that and exacerbated a lot of inequality over the past 18 months and set back poverty levels. But that's not to say it can't be done, because, to be honest, if all the money that was going into sustainable finance and ESG was actually going into sustainable finance and ESG, there would not be a financing gap. There are $30 trillion classified as sustainable, investments as of now. The problem is it's not being directed to the right places. It's not being efficiently used or effectively used. So I don't think, and there's a lot of capital available. There's a vast amount of capital available. To be honest, the wealth in the last 18 months has gone up massively, which is a shame, because obviously inequality has been exacerbated. So it's not for lack of capital, but for, I think it just needs to be directed a lot more effectively. It needs to be managed and it needs to be measured with regards to what are the outcomes that are being obtained with regards to where that money is actually being invested and how businesses are operating. So I don't think it's unachievable. I don't think we can, we can't prioritize targets. I don't think anyone's in a position to say SDG 5 is more important than SDG 1, which is more important than SDG 13. I think they're all completely interconnected, and climate action has a significant impact on the social well-being of a lot of the population. But I think, sadly, it needs to be managed a lot better with regards to how the financing is being directed towards achieving the goals. That may be a controversial answer, but
thank you, Nita. I really appreciate that. Christopher?
Thank you. And as you might have understood, I'm a bit of a nerd when it comes to the mining, and that's also the most controversial area. So I think I will just stick to the goals and my area of expertise within that, because I think Mita and Robert, you covered the rest really good. But just to give a flavor and a perspective of what's going on there, and what we can see, and I've read a couple of really good reports on this, is that the mining industry overall, they are committed to, or a lot of companies are committed to reaching the Paris Agreement targets and also the SDGs, and mainly like reaching the 1.5 degrees and 0 degrees targets for 2050. And there is a plan for these companies to transition. It's like if you look at the mining company, the vast majority of if you look at carbon emissions, for example, come from the energy they use in their when they operate in the mine and the machines. And still today, there's a lot of like oil and diesel and natural gas that is used to run these machines. And just if you remove that part, if you reduce that to about 50%, with 50%, then you're by 2030, then you have reached the first part of the goal towards less than 2 degrees global warming. So if we just execute on these plans and make sure that the transition towards renewable energy within mining continues, then we can reach these goals. But of course, if we just look at the car companies in the world, they have said that they will be net zero emissions on some 2025 and some in 2030, and I think that will be really difficult. Ambitious goals, it's a goal, and even ambitious goals can be good in some senses, but they should also be realistic, and they should also be thoroughly monitored and measured along the way, because otherwise they are basically greenwashing as well, as we have been talking to before. So that's what we do with mining, of course. They have set their targets, they have set their plans, and we want to make sure that they follow them. So we actually reach these targets, and I think there's a great, I think we will reach them if we continue in this direction. But it's, then I've talked for the mining industry as a bubble where it happens, a lot. I think I'll wrap it up there.
Thank you, Christopher. I really appreciate that. Robert?
Yeah, look, I mean, that's a difficult question. I mean, you can look at the stats on the progress we've been making against the SDGs, but like Mita said, they're all interconnected. And I think, as basically Christopher embodies, I think it's about figuring out what you're passionate about and what's important to you, and working and contributing to progress against that goal and those goals at the SDG level. Or if it's in your work, figuring out how to help your organization put a better strategic plan in place and prioritizing 1, 2, 3, or a set of goals and working towards those. So, because what we're talking about are just monumental feats of, course correcting years and years of, just things that are systematically kind of wrong in industry and society. So I think it's about, how do we keep working towards that? So it's about finding what's important to you and, figuring out a plan to contribute to those goals. So I'll end it with that.
So you just said it'll end it, but I've actually got one last question, which actually goes to what you just said, Robert.
Sure.
I want to know, from a personal perspective, what made you to enter this space? So, why did you choose a life or a job or career within this kind of space? And, is it for, a personal reason, or was it the fact that you saw the effects on, the economy of the society as a whole?
For me, it was kind of like what I just said, wanting to kind of figure out and follow what I was passionate about. And, when it came down to it, I was really passionate about helping really see more equality in the world. I think it's such a stark contrast, right? When you travel around the world in different countries, and then you see kind of the wastefulness and inefficiencies or even hypocrisies in the way in which people act. So just really level setting things a bit better so that, I feel like the world is operating in a better way. So for me, it was always about kind of wanting to really see and have impact in my work through kind of economic development in emerging markets. And that's kind of what drove me, and I've kind of followed that thread throughout my career. Growing up in, let's say, suburbia America, and realizing that there was a lot more just general impact that needed to be created in the world than kind of where I came from. So yeah, I think that's just, I've tried to kind of always follow interesting and passionate work.
Thank you, Robert. Really appreciate that. So let's have any last remarks. Does anybody have any last remarks before we wrap up our session today? We actually don't have any questions from the audience. So I just want to know if you have any last remarks, or if you obviously want to promote your companies, please feel free to do so in this last 2 minutes.
I could just say that if you have any questions or anything that I've mentioned, just connect with me on LinkedIn, and I'm happy to answer any questions. And you can also check out what we do on auagfunds.com if you want to learn more. But yeah, I'm happy to. I like to talk about this topic, as you might have heard. So just feel free to reach out if you have any questions. And of course, thank you for inviting me, and it was a pleasure. Robert, Nita, and Susan. Thanks.
Yeah, no, I'm same. If anyone wants to reach out and discuss impact measurement, I'm like heavily involved in this space. And a very shameless plug, we do actually do impact measurement as a SaaS solution for like firms and funds. So happy to share more on that, or just discuss the sector, the wider sector. Like impact investing is certainly a passion, or has become a passion of mine over the last few years. So happy to connect on LinkedIn with everyone. And then thank you, Susan, for inviting us, and Robert and Christopher for a very nice discussion. Really enjoyed it. Thank you.
And maybe I'll just chime in to echo that, look, this is something I'm passionate about. Happy to talk with others because I feel like it is kind of a nebulous and new topic. So always happy to help people think through it. And Suzanne, thank you for hosting this, because I think, we have to keep kind of talking about this in a broader way, because, we probably find ourselves operating in a little bit of a bubble and, preaching to the choir, just talking to people that are very familiar with this. But we got to expand the horizon and understanding around this to more of the general populace. So I think it's important to have sessions like this. So thank you for convening us.
Thank you all to all our panelists for sharing their formidable insights with our audience today. I really appreciate you guys jumping on calls. So this was really last minute. So I really appreciate our panelists for obviously extending their time this afternoon to share their insights. So I really appreciate that. And thank you to our audience as well. So have a good afternoon and a lovely weekend, and take care and keep doing good things. Take care. Bye.
Thank you. Bye-bye.